In this video, we talk about several important balance sheet line items. The first one is cash and equivalents. Cash and equivalents represents extremely liquid assets, and examples include U.S. Treasury bills, which have a term of less than or equal to 90 days. You'll also see marketable securities, which represent debt or equity investments held by the company, included in this line item or broken out separately. But they're all, from an analytical standpoint, all aggregated together. When you think about cash, it's not just straight cash when you see it on the balance sheet. There are also cash equivalents, which are basically anything that could be easily converted to cash. So think about money market accounts, or again, U.S. Treasuries, which could at any moment be sold, which are short-term in nature. And here we have Walmart's cash and equivalents. They have about $6.5 billion in cash and equivalents. And we have a footnote disclosure that identifies exactly what the nature of those cash and equivalents are. We see that the company considers investments with the maturity when purchased of 3 months or less to be cash equivalents. All credit card, debit card, and electronic benefit transfer transactions that process in less than 7 days are classified as cash and cash equivalents. So we see that it includes restricted cash primarily related to cash collateral holdings, etc., etc. So cash and equivalents for most companies represents highly liquid investments or cash itself. We next turn to accounts receivable. Accounts receivable represents sales that a company has made on credit. The product has been sold and delivered, but the company has not yet received the cash for the sale. Below is Walmart's description of what is included in their accounts receivable, and we see that it represents a pretty significant line item. The company has as much in accounts receivable as they do in cash almost. So receivables are stated at their carrying values net of a reserve for doubtful accounts, and which we're going to touch on that a little bit. Receivables consist primarily of amounts due from insurance companies resulting from pharmacy sales. So when Walmart in their in-store pharmacy sells prescription drugs, they're waiting for insurance to pay them back. It's not the consumer who directly pays beyond the copay, and so they're waiting for insurance companies to pay. So that makes up a good chunk of their receivables. Now, banks for customer credit cards, debit cards, and electronic bank transfers that take in excess of 7 days to process, that's going to transition away from cash and equivalents and into receivables because it's taken more than the several day threshold that they've identified for what counts as cash and equivalents. In fact, if we go back to the prior slide, we see that any credit card debt and transfers that are in process for less than 7 days are going to be cash and equivalents. But if it's more than 7 days, it becomes a receivable. Now, suppliers that owe them money for marketing or incentive programs, consumer financing programs, etc., these are all things that end up making the receivables line item for Walmart. Now, accounts receivable are linked to revenue on the income statement. Suppose a book publisher has sold books to several book retailers and so far has collected $800 in cash, and the remaining $200 is due within 14 days. Recall that under accrual accounting, what's recognized for revenues is the full $1,000 because revenues are recognized when they are earned and the payment is reasonably assured. And that's, in this case, we're going to assume that the payment is reasonably assured, and certainly by the publisher sending the books, they have earned the revenue. So what I'd like to show is the journal entries that would follow for this particular transaction. So you would see that the cash would be debited by $800. The publisher received $800 in cash, but revenues would be recognized on the income statement, and therefore whenever revenues are recognized or any sort of income on the income statement is recognized, the impact on the balance sheet is retained earnings. So we see a $1,000 credit to retained earnings and an $800 debit to cash. Obviously here, debits don't equal credits. In the offsetting entry to make everything balance is the recognition that now you have $200 in money owed to you over the next 14 days, and that's going to qualify as accounts receivable. Next, we address prepaid expenses. Prepaid expenses, although it has the word expenses in it, is not something that actually impacts the income statement immediately. It's a balance sheet asset. And it's probably one of the less intuitive balance sheet assets. When a company prepays for things like utilities, insurance, and rents, cash is reduced, but the expense is not yet recognized on the income statement. Instead, it's recognized as an asset. Now, before we go any further, take a look at Procter & Gamble's balance sheet. What you'll see is that they have cash, accounts receivable. They have several other line items that we're going to talk about. But one pretty significant line item that we're about to talk about now is these prepaid expenses. They have about 3.6 billion of them. Now, why would you recognize utilities, insurance, and rents as an asset instead of expensing it on the income statement? Well, it's the accrual concept again. Under the accrual concept, expenses are recognized when the associate benefit has been received. So with prepayments, the benefit hasn't yet been received. So an asset is created to reflect that the company now has the right to the future services. Suppose that a company decided to prepay $5,000 to cover the next 12 months worth of utilities because of a discount presumably offered by the electric company. So let's try to identify what the journal entries would look like. Now, if we assume that the utility expenses ultimately impact the SG&A line item when they're finally recognized as an expense, let's give this a try. Hit the pause button and try to identify what the debits and credits, what the impacts would be on the day of the prepayment, the original day of the prepayment when you spent the $5,000, as well as what would happen 6 months later after half a year's worth of utilities have been used up. What adjustments would need to get made from day 1 to 6 months later. Hit the pause button when you're ready, hit unpause, and we'll talk about it together as a group. So on the day of the prepayment, it's pretty straightforward. Cash goes down by 5, and the corresponding entry is the creation of a new asset called prepaid expenses. Again, that reflects the fact that the benefits from these expenses have not yet been received, and so now we recognize that in the future, the vendors, the electric company, owes us these benefits. That's an asset. Now, 6 months later, half of the utilities presumably have already been consumed. Half of the electricity has been consumed. And so what ends up happening is this prepaid expense account that's sitting here, this prepaid expense, is sitting on the balance sheet, and it's going to go down from 5 down to 2.5. It's going to go down by 2.5. It's going to be a $2,500 credit. And the reason it's going to do that is because the expense is being recognized on the income statement finally. Because the electricity is being consumed, it's being recognized in SG&A, and so it's reducing retained earnings. Retained earnings is going down, and the corresponding asset is going down. So equity is going down, and assets going down, and everything is in balance. There's a credit to the asset and a debit to the equity. For those of you who are wondering what happened 6 months after that, well, another $2,500 worth of credit to prepaid expenses, bringing it down all the way to 0. So by the end of the year, you fully used up all the electricity you prepaid, and retained earnings went down by another 2.5. You will have, by the end of the year, recognized a full $5,000 worth of SG&A expense associated with utilities, just not at the beginning.